Hey there, Risley Goldsboro here from Harding Szymanski and Company. Very excited to share powerful information with all of you from the tax department. And I have two tax department experts here with me, Aaron Wilzbacher, who's the vice president, and also manager Susan Tysing, to talk about some things you really want to think about as we are approaching the end of the year. And Susan and Aaron, thanks so much for being here. Susan, we'll start with you today. So let's suppose that I have a small business that has substantial business income for this year, 2023. Is there anything that I can utilize around fixed assets to help reduce my taxable income?
You can use fixed assets to help reduce your taxable income. An easy way to accomplish this goal is to accelerate the purchase of your fixed assets and place them into service in 2023. Those purchases are going to be eligible to take depreciation in the 23 tax year. When it comes to tax depreciation, businesses have two options: bonus or Section 179. Bonus depreciation is going to allow a business to deduct a large portion of the asset cost, while Section 179 will allow businesses to immediately expense the full cost of qualifying assets. Bonus depreciation can be a great option for businesses that want to expense a large portion of their purchase in the year they place them into service. However, bonus depreciation isn't available for all asset types, and the percentage of costs that can be deducted is set to decrease over time. In 2022, bonus depreciation was 100%, the cost of qualifying asset. For 2023, it's been reduced to 80%, and it's set to decrease by 20% until it's fully phased out in 2027. Section 179 depreciation, on the other hand, allows a business to immediately expense the full cost of the qualifying asset up to a certain limit. Federal limit in 23 is currently $1.16 million. If you're making significant purchases, the ability to take 179 on those purchases is going to phase out between $2.89 million and is fully phased out by $4.89 million. States also have limits. For 2023, you can take up to $25,000 of 179 in Indiana and up to $100,000 in Kentucky. Section 179 is available for a wider range of assets than bonus depreciation, and it's considered to be a little more flexible. If you have a target taxable income in mind, you can take Section 179 on some of your new purchases and not others. While for bonus, you're required to take bonus on all assets within that same asset class. So which do you choose? To fully accelerate tax depreciation, it probably makes more sense this year to use 179 versus bonus, since bonus is only allowing an 80% expense. Ultimately, you want to work with your tax advisor at Harding Szymanski to help you make those final decisions.
Thank you. So, Aaron, I've heard a lot about some elections that you can make to deduct certain pass-through taxes. Can you explain to us what that means?
Pass-through entity tax elections is something that's fairly new. Basically, with the 2018 tax law changes, many taxpayers were capped at the amount of itemized deductions that they could take for state income taxes, real estate taxes paid, and also excise tax. That cap was at $10,000. So it limited a lot of the individuals to be able to utilize any type of state tax deduction to get the benefit for that. Therefore, a couple of high tax rate states developed a workaround that allowed partnerships and S corporations to pay the tax on behalf of the partner or shareholder. This allowed the partner or shareholder to receive a federal tax benefit, even if that shareholder or partner at the individual level was subject to that $10,000 cap or took the standard deduction. Basically, this election allows the business to now have the tax burden instead of the partner or shareholder, and allows the business to take the tax deduction at the federal level. This tax deduction actually decreases the operating income from the partnership or the S corporation. Indiana and Kentucky adopted this workaround in 2020 or 2023, effective for tax year 2022. One item to note before the end of the year is that some of these states require these pass-through entities to make an estimated tax payment, whereas before they didn't have to do that. And also making this estimate before the end of the year allows the partnership or S corporation to get a deduction in 2023. Otherwise, the deduction isn't deducted until the year paid, which might be 2024. One other item to note is the tax payments made on behalf of the shareholder or partner are usually passed through on the partner's K-1. It is crucial that the individual return reflect this payment correctly.
Susan, I'm a charitably inclined individual. How do I utilize contributions to maximize my tax benefits?
You can utilize contributions to maximize your tax benefit. Giving back to your community is not only a noble thing to do, but it also helps reduce your overall tax burden. There are several ways you can make a charitable contribution. You can donate cash, securities, property, or even services to a qualified organization, and in return receive a tax deduction for the value of your donation. To maximize your tax benefit of a charitable contribution, individuals should consider donating appreciated securities. By donating securities that have increased in value since they were either purchased or inherited, individuals can avoid paying capital gains taxes on the appreciation, while also receiving a tax deduction for the full value of the security. Quick example, you have stock with a basis of $1. Stock is worth $10 today. If you were to sell that stock on the market, you'd be subject to $9 of capital gains tax. To avoid the tax, you can donate the stock to a charitable organization and receive a deduction for the full $10 value. Another option is to set up a donor-advised fund. A donor-advised fund is essentially a separate account used for charitable giving. An individual makes contributions to this fund and in return receives a deduction for their tax return. Great thing about these funds is the contributions don't necessarily have to be distributed right away. They can be deferred to later years when the charity of your choice needs them. Another option for charitable giving for those who have required minimum distributions from their IRA is to, in lieu of making those RMDs, they make instead a qualified charitable distribution or a QCD. QCDs allow individuals to donate up to $100,000 directly from their IRA to the charity of their choice. These distributions are non-taxable. So if you are charitably inclined and also required to make required minimum distributions, this is a great option for you to help reduce your tax burden. I also want to briefly mention age limits for RMDs changed to 73 in 2023. There are also limitations on the overall amount of charitable contributions individuals can deduct on their tax returns. However, by planning ahead and making strategic donations, you can maximize your overall tax benefit while still supporting the causes that are important to you.
Excellent. Aaron, back to you. I am a cash basis taxpayer. So what things do I need to think about and consider as we get toward the end of this year?
There are several items that cash basis taxpayers need to consider before the end of the year. We suggest that you start planning well before the end of the year so you can take advantage of some of these items to target your taxable income or to lower your taxable income. Taxpayers should consider what cash is expected to be received by 12/31 and also what expenses they expect to pay out before the end of the year. Like I said before, cash basis taxpayers have a unique opportunity to target taxable income by managing their accounts receivable by the end of the year and also their accounts payable. Taxpayers that expect a large tax liability can do things such as pay expenses off before the end of the year, such as expenses not related to inventory. They could pay bonuses to employees or shareholders before the end of the year. That would usually otherwise be paid in January or February or March. They could also accelerate their personal property taxes that normally would be paid in January or February. They could accelerate that to before the end of the year, or payroll that maybe would be at the first part of January. They could move that up to the end of December. But planning for those expenses could also be a cash burden for the company. So as you start planning now for that is very important instead of waiting till 12/31 or 12/30 to make these decisions. The other side of this is to look at accounts receivable. So if you expect a lot of clients to pay you for the services or any other items that you're selling, and they pay that before the end of the year, you've got to pick that up as income in this year. And so managing that piece of it is also helpful to target that taxable income. Also keep in mind that this is a cash flow issue. So if you're paying off a lot of expenses, that's going to eat into some of your cash. If you decide to delay some accounts receivable by not billing, that's also going to be less cash that you have in. So keep in mind the non-tax items as well to keep your business running.
Thank you very much, Susan and Aaron, for sharing these insights with all of us. Our clients and prospects and ourselves need to think about all of these things before the year ends and prepare for them. And we deeply appreciate your time and wisdom. Again, thanks so much.